Well, as stock investors calm down a bit and buy stocks the last week or so, bond investors appear nervous. They've dumped stocks and rates have spiked. Just check out the difference between volatility expected in the bond market and in the stock market. Look at the rate volatility, the blue line, boom. Equity volatility, not so much. That has calmed down, and you can see where the election is on the right side of the screen. Which asset class maybe has it right? Welcome to Trading Nation. I'm Brian Sullivan. Gina, Sanchez, and Matt Maley are your guests. Kind of a Matt, keep calm and carry on in certain ways for the market, the stock market. The bond market seems to literally be Kevin Bacon's character at the end of Animal House. Stay calm as everybody runs over him and he's left flat on the street. Which market is getting it right and which one is getting it wrong?
Well, I would say they're both, to a degree, getting it wrong, because I think the bond market's gone too far over a near-term basis. But over a longer-term basis, they seem to be having it more right. I mean, I know Bill Miller came out today and said that the bond market, we've seen the low in rates and the top in the 35-year bull market in bonds, and like 2013, everybody's going to take their money from the bond market and put it into the stock market. The problem with that is that may happen, but the problem is through most of the past 35 years, when the bond market and the stock market traded in tandem, and so did their volatility. So I think that they've gone a little bit too much on the bond side. Everybody is on one side of the boat. Everybody is negative on the bond market. That'll ease off a little bit as we move towards the end of the year, but I think it'll pick back up again. And then as rates move higher, the cost of leverage will move up, and that will create a headwind for the stock market, especially with the elevated valuations that we're faced with.
Okay, Gina, you think the bond market, maybe the stock market has overreacted, underreacted?
Well, I think they're actually telling us two different stories, and so I think it's important to read in. The equity market is largely telling us, okay, we don't know what's happening yet, we're taking a wait-and-see mode, and at least we've got that behind us, and we have earnings more or less moving in a positive direction. So I think that's been what's driving the stock market, and so that's very much a wait-and-see kind of pattern, whereas the bond markets basically say, well, we know that all of the expectations for the budget are not self-financing. We're likely going to have to issue more bonds. That's going to put more pressure on bond yields, and we're expecting potential inflation. And so neither of those things is good for bonds. And if you couple that with the fact that we're likely to see moderated growth in that time frame, I think the bond market has it more right than the stock market, in that they're saying, look, we kind of already know these things. Even in a moderated, okay version of the presidency, we're still going to face with these realities.
Yeah, and if you ask the bond market who's smarter, the bond market will tell you the bond market. It's amazing how that works. But your point's, bond guys tell me they're the smartest of all. Stock guys say the same thing. Gina and Matt, thank you both very much. We appreciate it. Wow, big jump in expected volatility. Folks, thank you for watching Trading Nation. Check out the live version in the 2 p.m. Eastern Time hour of CNBC every day. I'll see you there as well. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.